This month, the UK gilt markets came to resemble, some people say, emerging markets. Even as the government announced tax cuts there, buyers for government bonds completely vanished because they feared a surfeit of bond issuances from the government. As yields soared, the Bank of England had to come in and buy bonds and infuse liquidity, although it stated policies to actually withdraw liquidity to cool down the 10% inflation. The problem, as economists Raghuram Rajan and Viral Acharya write in a recent paper, is many pension funds who were earning very little when interest rates were zero had taken on a lot of leverage through derivatives. But when interest rates rose, these funds had to bring in more margin money, for which they would have had to sell bonds, which will take bond prices even lower. More generally, Rajan and Acharya say the series of rate hikes and liquidity reduction by central banks can lead to accidents, big institutions failing. To explain the dangers global markets may face, we have with us the man himself, Dr. Raghuram Rajan, former Reserve Bank governor, co-author of the paper I mentioned, and someone who smelt the previous Lehman crisis much before many central bankers did. Thank you very much, Dr. Rajan, for joining us.
Thank you for having me.
Okay, well, first, the question is this UK gilt problem. You point out that big pension funds may be out of pocket. Can you explain how serious is the problem because of a rapid rise in rates?
Right. So, pension funds basically have long-term liabilities. They have to pay for pensions, 10, 15, 20 years down the line. And so, from that perspective, when you take the present value of their liabilities, you're basically, these pension funds are better off when rates go up because they owe less in present value terms. The problem, however, is they also have to earn on their assets. And so what they did in the time of low interest rates, when their liabilities were really high, was they not only bought gilts, but they levered up in order to buy more gilts. So what happened was when interest rates went up, because of the British government basically spending more, the value of gilts fell. And so their assets became lower valued. Their liabilities also became low valued. So on net, they were hedged. But the problem was, in order to take the asset play, they had bought into a bunch of derivatives. And so what they needed was immediate money to make up the difference. That was what forced them into starting to sell some of their assets because they didn't have the money. So this was a strategy which made them okay value-wise, but they didn't have the liquidity to pay up when things went belly up, when bonds went belly up. So,
No. So do you think that this temporary infusion of liquidity will stave off any liquidity crisis? I mean, this is not a systemic problem.
No, it is. Here's the problem, right? That during the, what happened during this period of easy money is not only did you have low interest rates, but also the central banks, the Fed, the Bank of England, the Bank of Japan, flooded the market with liquidity by expanding the balance sheet. What does that mean? They basically bought bonds and issued reserves. Reserves are very, very liquid. And so in this period, when the central bank floods the market with liquidity, banks that have to hold that liquidity, what do? They basically write all sorts of claims on liquidity. They issue demand deposits, they issue lines of credit. So this is all very good when the central banks are supplying the market with liquidity. Now what is happening is they're withdrawing liquidity. When they're withdrawing liquidity, it turns out that all these claims start becoming a little more anxious. So what happened with the British pension funds, that they couldn't find the liquidity to make up some of the demands on them, is more true generally. There's a lot of leverage out there. There are a lot of potential liquidity claims which may come due. And when the central bank is tightening its balance sheet, this is much more likely. So what we're saying in this article, in this paper we wrote at Jackson Hole, is look, the real problem is you're trying to raise interest rates, which creates a lot of market volatility. at the same time that the central banks are also pulling back liquidity.
Okay.
This creates a lot of problems for financial markets.
Okay.
You said the gilts are happy in the UK. Well, this morning, again, there is a lot of speculation that the Bank of England will have to come in yet once again,
Yeah.
and gilts are plunging at this point because, Andrew Bailey said yesterday that they won't come in. So markets are testing the central banks and saying, look, you can't raise interest rates and withdraw liquidity at the same time, even though you need that for monetary tightening.
Okay, so the rates were zero, not just in the UK, but also in all of Europe and the United States, and they also have pension funds with defined liabilities. So should we see this problem copy-pasted there as well?
Not in the same way, but in different ways. So there are different entities that have taken on different kinds of liabilities in the US. But remember, in the UK, the precipitating factor was the government doing this unfunded spending, which tanked the value of the bonds. Hopefully, other governments are a lot more circumspect elsewhere, but any kind of market volatility which changes asset prices in a big way will raise demands for liquidity as margin calls come, et cetera, et cetera. And in a situation where liquidity is tight, it could precipitate the kind of events we've seen in the UK market. So you need a combination of factors. It's not just going to happen, without any of these factors, but volatility can precipitate this kind of what we've seen in the UK market.
Can we say, Dr. Rajan, that this is a known? All the central bankers are watching these potential financial instability issues like a hawk. So we perhaps will not have a seriously dysfunctional system. I mean, nothing like a market seizure we saw during Lehman.
Well, there is a fix they have, which is to come back to supply liquidity. So in that sense, yes. I won't say it's a known. They weren't sensitive to this issue, but a bunch of us have been raising this issue. Market participants have been raising this issue. So I think they are now sensitized to this issue. They know they cannot withdraw liquidity without watching, as you said, like a hawk, to see if the market is becoming illiquid. Certainly, there are signs of illiquidity in the US market also. So I think the news from the UK is the central bank cannot leave the market to function on its own. The market has become liquidity dependent, as we say, and therefore they may have to come back if they see signs of liquidity. I would say that the need of the hour is more higher interest rates to quell inflation. They should not try at the same time to shrink their balance sheets, even though it moves in the same direction. They should leave that aside for the moment or go slow on balance sheet tightening, because many of them have announced significant balance sheet tightening, and they'll have to reverse that if they don't want liquidity scares.
Okay. I'll come back to central bank solutions in just a minute. A little more in terms of analysis of the current problem. How would you compare this, the current situation of global markets with the Lehman time? It appears to me that in the Lehman time, the US itself was in a hole with many of their banks very poorly capitalized. In contrast, many of the banks outside in countries like India and even in Spain were well capitalized. But now the US seems to be very strong, and the rest of the world seems to be therefore facing the brunt of a strong dollar.
Absolutely. I mean, so it is, as always, our dollar, your problem in the US. And really, I mean, the Fed can't do very much about it. It has a domestic mandate. I've been saying for years that, central banks in industrial countries should worry about the consequences. During the time of buildup, easing money through quantitative easing tends to flow through the world and create, problems down the line when the central banks have to tighten. So you have to be concerned about that. Of course, at this point, we are where we are. The Fed has to tighten because inflation is up. It may have to stay at relatively high interest rates for a sustained period of time. What is sustained? There's a huge amount of debate about that, but I would say probably not before 2024 will it even contemplate some form of easing. And so given that, conditions are going to remain fairly tight across the world. And central banks everywhere, seeing their currencies depreciate against the dollar, can point to the other currencies depreciating and saying this is really a strong dollar problem rather than a weak local currency problem. But in order to avoid importing inflation via higher commodity prices, higher prices of everything else that is priced in dollars, they have to work on preserving the strength of their currency, which means not just exchange rate intervention, which I would do as little as possible, but focus on monetary policy, quelling inflation, and keeping the currency stable. So this is something that every central bank is grappling with, and I think it is a consequence of the fact that the Federal Reserve is essentially the central bank for the world, and it tightens according to what's happening in the U.S. markets, not according to what's happening in the world.
So your best guess is the Fed is not going to blink. The dot chart saying 75 in November, 50 in March, and another possible 25 or 50 in next March will pretty much be the way it will play out. They're not going to blink because of UK or Europe or even slow down in their own country.
Well, they want to slow down. Really, they want labor markets to come off the boil. Even today, firms are still not firing workers. They're holding workers because they've had a desperately hard time hiring workers. And there's still shortages in every area of the service sector. So, to some extent, the Fed will not slow down until it sees a possible slowing in the U.S. economy. The problem, of course, in any kind of intervention of this sort is that the risk of overdoing it is serious because monetary policy works with long lags. So you raise interest rates today, but the slowdown happens 2 or 3 quarters down the line. And therefore, if you keep raising interest rates until the point of slowdown, you probably have done too much. It gets a momentum of its own.
That's right.
That is the worry. It's a worry that the Fed is certainly aware of, and it's probably watching every indicator to see whether the slowdown is sufficient. I do think inflation, unless we see a dramatic increase in energy prices once more, inflation is coming down. And, sometime in the early to middle part of next year, they will say, well, we've done enough to wait and watch because inflation is coming down. Labor markets are showing some slack. I mean, one of the pieces of good news over the last few weeks has been the job openings in the US suddenly come down by 1 million. So it may be that we are starting to move in the right direction.
Okay.
But still ways to go because labor markets, last labor report was still quite strong. So still some time to come, unless we have a dramatic collapse in financial markets or a dramatic slowdown in labor markets. I think the Fed is on course till about 4.5, 5. Pause then, and then watch. Till it sees real signs that inflation is going to come in the bag.
That's what's penciled in by the futures markets. But the more important question, what about emerging markets? That very important question. After the break, Dr. Rajan, we are back in a jiffy. Welcome back. I've been speaking with Dr. Raghuram Rajan, former Reserve Bank of India governor and author of a paper which analyzes how a rapid rise in interest rates can endanger some big institutions like pension funds. Dr. Rajan, thank you very much for waiting on. Your basic scenario, your base scenario is that the Fed is going to go on continuing rate hikes and you're not seeing a cut up until 2024. Now, what about emerging markets? We have already seen some weak wickets fall. I mean, we have seen unfortunate events in Sri Lanka, in Pakistan, in Zambia, in Chad, Ethiopia. You think the islands of some strength and good macros like India, Indonesia, Mexico can be relatively, escape with minor bruises?
Yeah, I think we have to wait and watch and be very cautious over this period. But certainly, countries like India, Brazil have significant reserves, and that will prove, to be a help, if difficulties arise. I think the issue is we're going to be in an high interest rate environment after a long period of low interest rates when countries have borrowed up considerably, corporations have borrowed up, many have borrowed in dollars. That is not an India problem, but it's a problem elsewhere in the world. And so as the dollar strengthens, as interest rates go up, debt service goes up. And right now what we're seeing is with the enormous withdrawal of funds from emerging market bond funds and so on, the appetite to buy new issues is diminishing. So the big problem for many countries is, debt service because they have to pay back the old debt, but they have no ability to issue new debt. And even if they had, it would be at much higher interest rates because interest rate spreads for emerging markets have also zoomed even as US interest rates have gone up. So it is a tough time. It has always been known that when the when interest rates go up, money goes back to industrial countries away from the emerging markets. We have prepared for it in India by building reserves, but it doesn't mean that we will be totally immune. Hopefully, we will weather the shock, as you said, with minor hiccups.
Okay. The solace in the market appears to be in countries like ours that we would be the last to be abandoned and probably the first ones to receive when probably the storm subsides.
I think that may well be true, but it's important not to be complacent about it, which is that you have to constantly focus on getting your macroeconomics right, on the central bank having a laser eye towards containing inflation, because the exchange rate, after all, focuses on medium to long-term inflation. And it needs to convince the markets that it is going to contain inflation. That's going to be good for the country. And I think if you focus on that rather than, day-to-day movements in the exchange rate, I think that, in my view, will pay off well for the country.
Okay. Coming back to developed markets, the inflation is high, okay, because the Fed and the BOE and ECB printed a lot of money. But it is also high because of non-monetary reasons. I mean, friendshoring, distrust between countries, war, aging population, resignations, no visas. I mean, visa offices are not even open in Mumbai for tourists and students. So do you think we have to prepare for a secular inflation, even in the West?
I think not yet, because many of the reasons you talk about suggest that growth will be tepid, right? They constraints on growth. And if growth is tepid, it is below what the potential rate for the economy is, so long as you don't have supply side constraints. So after combating and bringing down the high level of inflation that we have now, the expectation is we go back to the slow growth malaise that we had in between the global financial crisis and the pandemic. That would tend to essentially keep a lid on inflation. The problem right now is we've got a perfect storm of strong demand in the US, combined with supply side constraints. Of course, in Europe, the supply side constraints are higher with the energy prices and the lack of gas. In the US, it's stronger demand, which is the problem. But that's creating a perfect storm. My sense is, eventually the demand abates. People get, have spent through their cash hoards that they built up during the pandemic, and they start worrying about their jobs. They don't, want to spend as much, and inflation abates. But then you start looking at growth, and as you said, many of these factors, the deglobalization. Not yet a big, you don't see it in the data yet, but it will come. And these kinds of factors will take us back to slow growth. So I don't think the inflation, yes, there will be an inflation scare, but I don't think there will be a significant inflation premium embedded, provided the central banks sort of carry out their mandate and are successful in bringing down inflation.
Okay, well, there were some people who were arguing that the fact that you are nearshoring, you did not have the great deflation which the world was able to enjoy because production was outsourced to China. With all those nearshoring, cost of production will go up, and therefore inflation is likely to remain high. And therefore, even governments like India, I mean, Reserve Bank of India or central banks like that need not fuss about 4%, but can be comfortable even if it is below 6%. That is, the 2 to 6% mandate of the MPC. You don't buy that you have to adjust to slightly higher inflation.
I don't think so. I mean, I think what you're talking about are one-off adjustments, right?
Okay,
yes,
okay.
supply
Not
chains will
secular.
become costlier, etc. It doesn't necessarily need to be a secular adjustment. And to some extent, what you're talking about is relative prices will have to change because of these kinds of effects. So if in fact your cost of plastics goes up, other prices will come down. It doesn't need to be that everything goes up. That kind of adjustment will happen once you've contained inflation. But if you're sort of merely saying, oh, for all these reasons, we will set a higher inflation target, you will be at that inflation target and in fact have problems in keeping it there and not going further up. So I think you can't be lax about this.
Okay. Well, let me just come to the growth question, since you said a couple of times that we are going to see a return of the slow growth that the world suffered in the decade gone by. That will mean it will be difficult for even countries like India to get to that aspirational 7 to 8% growth?
I think so. I think that even before the pandemic, we were seeing a significant slowdown. I think post-pandemic, given these headwinds, so pre-pandemic, we didn't have these headwinds. Now with all the reshoring, friendshoring, deglobalization, plus also the fact that industrial countries now have much higher debt levels as countries. And you mentioned aging. That's also starting to hit industrial countries. Which way that goes is a big debate. But put all these together, and I think the accent has to be on clean, clear reforms, which enhance the domestic rate of growth without excessive dependence on foreign demand to boost us. Obviously, you want to do as much as possible. You want to be part of global supply chains if you can, but a lot of it has to be, how do we reform our own economy so that we can rely not just on foreign demand but also domestic demand? How do we increase the health of lower middle class households or small and medium enterprises? That's going to be part of the answer.
Oh yes, sir. Bottom of the pyramid should always be a concern, and perhaps even more now after COVID. Dr. Rajan, just a final question. You leave me with, can we end this conversation with at least the solace that we will not have seizures like Lehman, that we will have dislocations which can be handled with liquidity. Perhaps we have to live with inflation for a longer bit, but this is not a market which will face us with seizures.
Look, all I can say is it's not yet Lehman. Okay. Here's the point, that Lehman wasn't about raising interest rates. Lehman was, the Fed had raised interest rates, but it had the option of cutting significantly because inflation wasn't as big a concern.
Okay.
I think we're going into this with inflation being a much bigger concern. So the notion that interest rates will remain high for a longer period is out there. Now, it's not going to be a collapse in the major banks as we saw in the global financial crisis, though, of course, we've seen Credit Suisse tottering a little bit. But I think it's going to be more in the shadow financial sector, which we know much less about. It's the pension funds, the ETFs, things like that people will start worrying about. So I would not be complacent and say, no, it's going to be different. I think that is for sure. Where the knocks come from, I think we have to be very, very careful and keep our eyes open. It could come from anywhere.
Okay, that's a lot of food for thought for the central bankers who have gathered for the IMF fund meeting, IMF World Bank meeting. Thank you very much, Dr. Rajan, for joining us with your insights.
Thank you.
Well, with that, we wrap up on this special edition of Indianomics. Very special. More updates and news lined up for you.